welcome to COVID-19, Your Questions Answered, a webinar series addressing your most pressing questions about the coronavirus pandemic. My name is Deborah George. I'm a director at FirstService Residential, and I'll be moderating today's webinar. Joining me is Babette Bennett-Marshall, Senior Vice President of Financial Services at FirstService Residential, Lee Katzman, Founding Partner at Katzman Chandler, Bill Kilgallen, Tax Principal at Hafer Certified Public Accountants and Consultants, and John Lee, Vice President at FirstService Financial. As North America's property management leader, FirstService Residential recognizes the growing concern over the coronavirus outbreak and its impact on community associations. We shared valuable insights for navigating this uncharted territory in our comprehensive 90-minute webinar, Navigating the Coronavirus Crisis in Your Community. The response to the information presented was overwhelmingly positive. In the weeks since, we've received hundreds of questions from property management professionals and board members like you on a variety of different topics, from access control and cleaning protocols to amenity usage, financial considerations, and reporting procedures. Over the next few weeks, we'll tackle these topics, offering guidance, sharing best practices, and providing practical information to help you navigate these unprecedented times. Today, we'll be answering your questions about COVID-19's potential impact on association budgets, including what to do about your association dues and late fees, financing options if your association is facing a shortfall, and whether or not community associations qualify for emergency relief funds.
Thanks, Deborah. I wanted to also, as the lawyer in the group, it would be me if I didn't give us a legal disclaimer for what we're talking about today. There are lots of topics we're discussing today, and information is changing on a daily basis. So please, anybody who's listening to this seminar and listening to the information we're providing, please understand that the information is not intended to and must not be construed as or relied upon as providing professional, medical, or legal advice of any kind on any issue at this time. Please always check with your individual attorney for legal advice.
Thank you, Lee. Let's move on to the most frequent questions we've received about financial management during this crisis. Our first question: what do we do if residents demand that we lower dues because amenities and common areas are restricted and therefore not accessible? Lee, how would you recommend boards address this?
Well, it's a hard time and everybody wants to pay less. So if owners demand that we lower dues because the amenities and common areas are restricted and not accessible, that doesn't really go in line with the way associations operate. If the pool is being used or not being used, state statutes and local ordinances still require the pool to be ready and accessible and kept in a clean condition. So even though our amenities potentially are not being used at this time, it doesn't mean the expense of those amenities are changing. In addition, Florida statutes doesn't provide for a waiver if you don't use the common elements of an obligation to pay your maintenance. So you don't have to use the pool all year. You still have to pay your maintenance payments as everybody else does. And that's Florida law. Other law I can't quote.
Thank you, Lee. Babette, would you like to weigh in?
Sure thing. I would caution taking the approach, I totally agree with Lee, I caution taking the approach to lower maintenance fees in times of uncertainties. While there may be some short-term savings related to the operation of the common areas, there may also be some expenses which may be increasing, such as increased attorney's consultation. So, a great example is we're constantly, now that we have, the rapidly changing environment, we're constantly reaching out to the attorneys for advice. Some of these expenses aren't budgeted. So, additional thoughts are with the shelter and home mandates, more people are staying home, which means that there will be increased trash costs related to increased trash pulls. So in my opinion, it is much more prudent for the association to be conservative and keep any potential surplus to hedge themselves should there be other unanticipated expenses. Over the years, my experience lowering dues typically eventually lead to special assessment later, which is much harder for many residents to afford.
Thank you, Babette. That's great insight. On to the next question. Our homeowners are asking us to relax our collection policies, including waiving late fees. What are we required to do, if anything? Should we do that? And what's the best way to go about it? Lee, what are boards required to do and how should they handle?
Well, obviously we're going through certain times and we don't know how long or short the pandemic will be and what it's going to have financially on our associations. Generally, we know that people in times of uncertainty tend to hunker down and conserve their assets, and we feel there's going to be no difference in this situation. So we believe that there will be increases in delinquencies going forward. I think that sending out notices now that we're going to be waiving late fees is the wrong message to send to our associations at this time. We will experience higher delinquencies coming up. We don't know how high, but waiving late fees or going out and affirmatively telling our membership we're going to waive late fees is really telling them that they don't need to pay their maintenance assessments. It's giving them a pass and saying, look, if you don't pay on time, we're not going to penalize you for that. I think we want to send right now. I think we have to have a conversation with our clients and our membership. Our boards need to talk to our members and tell them what they expect. And at this point in time, we really expect everyone to continue to pay their maintenance. If there are special circumstances, then they can certainly write letters to their board of directors and explain those circumstances. But as of right now, especially with shelter-in-place orders, we're the ones who are providing the shelter and the water and the electricity, and all those things come with a price tag. And we need to keep our monies coming in and also think about how we're going to deal with it in the future. But right now, I would resist the urge to do anything but to tell our association that we expect them to continue to make commitments as they have been before. And if there are any special circumstances, to please write to us as our board of directors and let us know about those circumstances at this time. And then as we go down the path in the future weeks, if adjustments need to be made, they'll be made at that time.
Thank you, Lee. And Babette, if a board would like to address their late fees, what's the best way to go about that?
I think that one of the key aspects that we want to note, in addition to what Lee said, is that whatever decision the board makes, that they're taking a general blanket rule that applies to all owners. Mainly because you could open up yourselves to liability if you treat owners differently. Plus, asking owners to demonstrate financial hardship can be an administrative burden and could result in additional costs to administer. So my recommendation is always consult with your attorney and or your CPA.
Can I jump back in for a second on that? I do appreciate that comment very, very much. Selective enforcement is always an issue. And I think if people write, we want to put the affirmative obligation on our membership. If they have a problem, we want them to tell us about it. Based upon the letters coming in and how many people are experiencing hardship and how many people really need that assistance, that's when the board can determine what additional steps they want to take, if any, on a blanket basis to assist the entire membership or offer the entire membership assistance, not just individual members. So yes, I'm happy you clarified that. I want to clarify my statement as well. Thank you.
Wonderful. Thank you both. Babette, the next question is for you. Our boards are asking, can we access reserve funds in this emergency?
Deborah, I get this question quite a bit. And my recommendation is that our statutes explicitly require that reserve funds should only be used for the intended purposes. And that's Florida statute. Some governing documents may allow for short-term use of the fund, but this will always require majority vote of owners. So this is another area that I would absolutely recommend that after reviewing your governing documents, that you also consult with your attorney and or CPA.
Thank you, Babette. Lee, would you like to add some insight to that or guidance?
I'd love to add something. The answer is you can access your reserve funds if you're using them for the purpose that they were collected for. So if you have a reserve fund for the roof and the roof needs work, and that obviously can be used for that purpose. But if you're looking to use reserve funds, as Babette says, for other purposes, it is going to require a vote of the membership in Florida. Even with emergency powers being enacted due to the state of emergency, still there is not, or there's great debate over how far that emergency reaches. But even if it's the farthest reaching, it does not reach to the point where boards can take reserve funds for a particular purpose and use them for another purpose, even in emergency situations. So I'm with Babette on this one.
Wonderful, thank you. And John, from FirstService Financial's perspective, how would you answer this question?
I would line up exactly with what Lee and Babette said for our Florida communities. The Georgia and Tennessee governance is not as strict as Florida. So our communities in Georgia and Tennessee can dip into their reserve funds to offset operating shortfalls as long as their documents don't indicate otherwise.
Thank you, John. And Bill, from your perspective, how would you answer this question?
I'm going to have to concur with what everyone else has said as well, too. The reserve funds are pretty sacrosanct here in Florida, and it needs something extraordinary to happen to have people dip into the reserves.
Wonderful. Thank you for all the great insight. Our next question, John, is for you. This question is at the forefront of our board's minds. Does our community association qualify for financial support from the government, such as the CARES Act?
Yeah, thank you, Deborah. This is a big one, and we're getting a lot of activity around this question. So there's two pieces of the CARES Act that we're hearing about on a daily basis. The first is what's called the Payroll Protection Program, or the PPP. And the guidance we're being given from our attorney and CPA partners, and even our banking partners, is that associations do not qualify for payroll assistance under the PPP. As we said earlier, we're monitoring this for new guidance on a daily basis, and if something changes, we'll certainly be updating that. The other program is called the Economic Injury Disaster Loan Program, EIDL, or the EIDL program. That requires small businesses to submit an application directly to the Small Business Administration through their website to apply for the loan. The application process is supposed to be pretty quick. But we've had a couple of communities submit, and the wait time that they've been given is about 3 weeks for an answer for the initial application process. This program has, good terms, conditions, and it offers up to a 30-year payback. We don't have any definitive guidance on that program yet, though. We've yet to see a community association either approved or denied for the EIDL program.
Thank you, John. Bill, in your experience with the CARES Act, how would you respond to this?
As I said to John when we were speaking yesterday, we're looking at a certain number of associations that have decided, in conjunction with their attorneys, that until there's clear guidance, they still didn't want to choose to participate or make application for the PPP program. However, as we've said, the guidance on that, on whether or not they're going to allow associations to participate, is still ongoing and could occur within the next couple of weeks. We don't have any communities as of yet that have applied for the Economic Injury Disaster Loan proceeds. So it's basically just been the PPP program. And the main reason for that, applying for that program, is those proceeds that come out potentially could be forgiven those loan amounts up to 100%.
Excellent, thank you. And Lee, from a legal perspective, what would be your guidance?
Well, we have associations that have direct hires, large master associations, where they have on their staff, on their payroll, direct people, janitorial, maintenance, land, things like that, where they are applying for the PPP program. They've applied, they were told that they weren't qualifying. The higher up people in the management company has reached out, and now they're asking us for a legal opinion to accompany the application, and they think that might do it. So there is, as Bill said, a lot of changing information going on day to day, a lot of people putting pressure on either state or federal government to amend these bills to make these exceptions for community associations, because we are the redheaded stepchild of the world. Even though almost half of the state of Florida lives in community associations, everybody forgets about us and thinks that we're not, to be dealt with in these types of documents, and we have to remind everybody all the time. So that type of thing.
Wonderful, thank you all. Moving on to the next question. If our association needs additional funds quickly to address shortfalls caused by COVID-19, would you recommend that we take out a short-term loan or levy a special assessment? Bobette, would you like to weigh in on this?
Absolutely. That's an excellent question. In a period of economic downturn, a special assessment can be devastating to the association, in that it could drive delinquencies up even more. In my experience back in 2008, 2009, the associations who chose to do special assessment fared much worse than those who took other options, such as short-term loans. Owners who may already be experiencing financial difficulties could most likely be put in an even more financial strains and further become delinquent. A short-term loan is a much more strategic approach that helps to level out the burden on the association with even smaller scheduled payments at low interest rates. So, I would absolutely say that a special assessment is not the way to go during a period of economic downturn.
Absolutely. And John, from FirstService Financial's perspective, in terms of short-term loans versus special assessments, what would be your perspective on that?
So we've set up a process with several of our banking partners to secure emergency lines of credit for potential operating shortfalls due to delinquency. And this is the route that we're recommending. The thing I can't stress enough, whether it's a traditional bank loan, a line of credit, or a loan through the SBA, is quantifying what the association will need and going through that exercise with your professionals to determine what the loan amount, the loan necessity is, right? Because any loan will have to be repaid. And so you want to really understand your cash position as you go in to apply for these lines of credit.
Absolutely. And Lee, I'd love to get your legal perspective on a loan versus a special.
The legal perspective is interesting because I appreciate all of the historical knowledge that Babette brings and John brings. 2008, 2005, 6, 7, 8, we all lived through that, and this is reminiscent of that. The thing that's complicated in this situation is we don't know how this economic is going to shake out. And we don't know, as opposed to the 2008, whether the actual value of the assets, the real estate values, are going to drop and how far they're going to drop. In 2008 is much different because the values dropped and we went into an upside down situation with our properties, and that caused a lot of more delinquency and foreclosure when people lost the asset that they had. House was valued at $600,000, all of a sudden now it's $300,000, the mortgage is $400,000. Now you had an asset with value and now you have nothing. So there's a lot of things to be seen going forward. I am 100% behind Bette and John regarding do not levy a special assessment. It's the time to borrow money. Your members are stressed financially. Your association will be stressed financially. How long conventional lenders will be loaning money when delinquency rates rise above their thresholds? Because we know that banks, once the delinquencies rise 10, 15%, banks turn the faucet off and say, we're not going to give you any more money. So there's complexities involved, and that's why this is an ever-changing situation that needs to be addressed on a weekly basis. Work with your management companies, work with the boards, and make a plan, and plan for if it's going to be good and plan for if it's going to be bad. But let's talk about making plans and thinking about how to deal with this as it comes. But loans, whether they're short-term or long-term, I will tell you that the SBA loans we discussed in the last slide, we did those disaster loans back in 2005, 6, 7 after the hurricanes, and we funded associations millions and millions of dollars where they were able to repay those loans back over 10 years at less than 3% or around 3% rate. So the idea now is to get money. If you're going to use it, you're not going to use it, I don't care. Let's get access to money. Let's get some funds available to us in case this thing goes sideways. And if it doesn't, we can always return the funds without payment penalties. No worries.
Absolutely.
That's what I recommend.
Thank you for that. And our last question, what kind of an impact should we expect to our budget, and how will FirstService Residential support us? Where should we look for other resources for support? Babette, what kind of impact should the boards expect, and what support is available?
Another excellent question, Deborah. We could see delinquencies increase over the next few months, and which would thereby impact our cash flows. So, let's face it, over 6 million people filed for unemployment over the past few weeks, and many of these individuals live in our communities. In order to support our associations, we recently formed a financial relief task force, which is a team of subject matter experts within the organization who will be addressing financial sustainability, which is at the core of our priorities during these uncertainties. It is imperative that we provide a roadmap as well as the tools that our valued leaders and associations can utilize as an aid in making thoughtful, purposeful, and fiscally prudent decisions for the long-term financial health of the association. In the coming weeks, the task force will be focused on 3 main deliverables, we will be putting together a handbook, which essentially is a useful guide to navigate during this period of uncertainty. The next thing that we're looking to get out of this is a defined forecasting tool, which essentially is a plug and play that all of her CAMs and her leaders are able to go in, plug in the numbers and all of their assumptions to determine what their cash flow needs are and any potential cash shortfall. Finally, the last thing that we're going to get from this is an accelerated budgeting process, because while we're in the middle of forecasting, it's, you know, it makes sense for us to start looking ahead as to what 2021 will look like. And so you will get a much earlier budget guide that we will publish much earlier than we typically do, which is typically in July. We're looking to publish by as early as June.
That's wonderful information. And Bill, from your perspective, what kind of impact should boards expect to their budget?
The board should be looking at the budgets as they're going through. One of the earlier points that you made was the fact that we didn't know what the attorney's fees would be going forward as a result from all this. So it's going to be a situation where you might want to closely monitor what the expenditures are, especially if they're outside of what your budget parameters are, so that you can address them going forward.
Wonderful. Thank you both. That's all the time we have today. On the screen, I have a few key takeaways from our discussion today. Babette, Bill, John, Lee, thank you for sharing vital information on financial management during this pandemic. The information is of tremendous value to the board members we serve. I have a few resources up on the screen, including an email where you can send additional questions we may not have covered today. Please feel free to submit those questions. Thank you for your participation in our webinar. Please keep an eye out for more information on upcoming webinars, as we believe our COVID-19 Your Questions Answered webinar series will provide valuable insights that you and your fellow board members can put into action into your communities. I think I speak for everyone on this panel when I say that times like these demonstrate the importance of what you do as board members. Thank you for your leadership in your community. And for our clients, thank you for allowing us to serve you and your residents during this difficult time. Thank you.